Well, good afternoon, everyone, and welcome. My name's Daniel Goot, and joining me this afternoon is my colleague, Doug Garrison. We are very excited that you joined us today. Today is part 2 of our 3-part series entitled Exiting ExxonMobil. And we've designed this webinar series specifically for you, just for those that are approaching retirement or thinking about retirement and work at ExxonMobil. So our goal at the end of today is that you have a better understanding of the options with your pension and your savings plan, and that you have more confidence that you can retire at this time. Now, a couple of housekeeping items before we get started. If you have any questions during the webinar, please use the Q&A button at the bottom. We will try to answer some questions during the webinar, and certainly we'll get to all of them by the end of the webinar. Number 2, if you click on your screen the View Options button, and then click Exit Full Screen, we believe that you will then be able to see not only our faces, but the slides at the same time. So again, View Options, Exit Full Screen. And then finally, tomorrow you'll get an email, hopefully this time with the correct link in it. Apologies for the mix-up with Zoom last week. But in the email will be a recording of today's webinar, as well as a link with all of the slides. So you don't have to take notes on anything that you see on the screen today. Before I hand it over to Doug to kind of get us started, I just want to give a quick bio of Doug Garrison for those that weren't able to join us last week. Doug Garrison is a retired ExxonMobil benefits manager who had over 30 years experience with the corporation. He joined us over 10 years ago as a financial advisor, and his breadth of knowledge of the ExxonMobil benefits programs is unparalleled in the financial advisor community. And we are so fortunate to have him as part of our team. Our team consists of 11 people, 6 of which are certified financial planners. Investec is a boutique wealth management firm that was founded in 1984 and specializes in working with ExxonMobil retirees. We have over 45 clients that have retired or are soon to retire from ExxonMobil, and we really know your benefits program and have helped those people do this transition that you're contemplating or maybe on the verge of doing, or maybe it's still several years away, but you've joined us now because you want to begin your education on the benefits and how to transition to retirement. So I'd now like to hand it over to Doug to begin his part.
Well, thank you, Daniel. And let me add my own welcome to all of you. We really appreciate your taking an hour of your time to spend with us this afternoon, exploring a couple of big ExxonMobil benefits. You know, if you search the internet for the topic big mistakes, you'll probably find several websites where people can jot down their thoughts about the big mistakes they've made over their lifetime. You'll see regrets about not visiting a relative who was in the hospital prior to that person passing on. You'll see other stories of people who say, well, I didn't take the career opportunity that was afforded to me and I regret that. Or I didn't pursue that boyfriend or girlfriend who might have changed my life forever. Now, we've not done an exhaustive search, but in my research, I did not find any indication that anybody documented a big mistake in how they took their pension benefit or the distribution of their 401k account. Now, there are a couple of different interpretations from that. Maybe that people don't want to admit to a mistake in those areas, or it may be that the relationship disappointments are more monumental in their consequences and more deserving of posting for the world to see on somebody's website. Or I guess it's possible that people just never make any mistakes in how they take their pension benefit or distribute their 401k plan. In our experience, however, we've discovered a certain nervousness among ExxonMobil near retirees, people who are getting ready to retire from ExxonMobil and from many other companies as well, with respect to the pension and the savings plan. Those benefits are, for most people, a considerable portion of their net wealth. And often the decisions that are made on those benefits are one time. You can't turn around and change them. You can't change your mind. So people approach these things somewhat cautiously. And we think that's fine. That's appropriate. We don't think people want to make a big mistake. So Daniel, today's session is intended to help people understand their options and make informed decisions. And if I were to offer a theme for the day, it would be make no big mistakes.
Very good, Doug, very good. So having said that, we are now going to talk about the agenda for what we're going to talk about today. But before we do that, I want to give a brief recap of session one. So last week, we really talked about 3 items. The first thing we talked about was your readiness for retirement. And we talked about this both from a personal and a psychological perspective, right? What do you plan to do in the second act of your life? And how do you feel currently about leaving your job? We then talked about the financial aspects and asked the question, do you feel you're financially ready to retire? And we talked about why having a financial plan can help ease some of those concerns that you may have. The third and final thing we talked about in good detail was timing. You have so many benefits there at ExxonMobil, but timing plays a key role into making sure that you can maximize your benefits, minimize your taxes. And so we focused a lot on the timing. Doug, I'd like you to kind of give us a little bit of a summary now on what we're going to go over in today's session.
Sure, Daniel. Today we're going to talk about 2 big benefits when you retire from ExxonMobil. Your ExxonMobil pension benefit and the ExxonMobil savings plan. We're going to cover the choices that you have, and we'll talk about some of the pros and cons of each of those choices. We're also going to spend some time talking about a tax-effective way for using low-cost shares of ExxonMobil stock that you might have in your savings plan account. We're talking about NUA, Net Unrealized Appreciation, and you'll hear the acronym NUA used repeatedly through that session, Net Unrealized Appreciation. Finally, we're going to cover the mechanics of actually taking distribution of your EMSP account. We'll talk about moving assets into an IRA or a Roth IRA or possibly into a brokerage account so that you're informed and you can make no big mistakes. Just to make sure we're on the same page, a brief review. If you're 55 and have at least 15 years of service, you're eligible to retire from Exxon with what's called retiree status. Now, retiree status gives you certain privileges which those folks who don't have that status don't get when they leave employment with ExxonMobil. One of the primary benefits of retiree status is you get to choose between taking your pension benefit as a lump sum or as an annuity or as a combination of both. The lump sum, as you probably know, is just what it says. It's a lump sum of money, typically rolled over into an IRA or possibly moved into the ExxonMobil savings plan, where it really just sort of sits there and hopefully grows until you decide you want some of the money. Moving the money into an IRA or into the savings plan is not in and of itself a taxable transaction. You only pay taxes when it comes out from the sort of tax protective umbrella of an IRA or the ExxonMobil savings plan. You invest the funds and hopefully you generate income and take that as you need it. Now, the annuity, on the other hand, is a payment from the ExxonMobil pension trust that comes to you every month, just like a paycheck. Just like the paycheck that you're getting now, it gets taxed when it's paid, and it provides a monthly income to you for as long as you live. Taxes are withheld as it's paid, as I mentioned, and you also likely have retiree medical expenses paid from it as well. All right, Daniel, I've talked a little bit about each of those. Do you want to talk about some of the pros and cons, helping people decide what they want to do?
Sure. So we've put a slide together here that we hope summarizes both the pros and the cons of the lump sum and the annuity. And there are pros and cons of each. So we're going to start with the pros of taking a lump sum. The first one is when you take a lump sum, as Doug just mentioned, you roll over that sum of money into an IRA. You then get to choose to invest the money as conservatively or as aggressively as you choose, and that bucket of money can grow over time. So you have the growth potential of your lump sum growing over time. The second benefit is with your IRA, as you probably know, you get to name your beneficiaries. So when you pass, you get to leave your IRA to your spouse and then your children, or anyone else in your family, or charity. So you get to leave your hard-earned dollars behind to someone that you choose. The third benefit is you really get to control your taxes better in retirement. Now, taxes and healthcare costs are going to be the two biggest things in retirement that you're going to have to look out for. By rolling over your lump sum into an IRA, you get to control how much comes out of your IRA, and thus how much your taxable income is year by year. So those are three pros to taking the lump sum. Let's talk about a couple of the cons, and there are a few. Two that we've come up with here. Number one, although I mentioned it was a pro, rolling over your lump sum into an IRA, unfortunately the markets don't always go up. We do have fluctuations in the stock market. I think we all saw that in March and April. On average, we have a bear market every 5 years. So your lump sum that you roll into an IRA will fluctuate as the stock and the bond markets fluctuate over time. For some people, that may be a concern. The second con that we've listed there is it really becomes your personal responsibility to turn that lump sum of money into an income stream for you in retirement. While you were working all these years, Exxon made a promise that at retirement, assuming certain criteria are met, we promise to give you either a lump sum of money or a guaranteed annuity pension for the rest of your life. And over all those years while you were working, Exxon took the responsibility of managing that money to ensure that it was there when you retire. Okay, we're now going to turn to the annuity, also known as the pension. And we're going to use these two terms tonight interchangeably. Annuity, pension, we mean the same thing by it. The first pro for taking the annuity is that you have a steady stream of income through your lifetime. Year after year, month after month, year after year, you know that your paycheck, just like it was from Exxon, will be deposited to your bank account each and every year. You also don't have to manage that part of your net worth, because if you take the annuity, Exxon is paying it to you each month, and you don't have to worry about investing the lump sum. Now, a couple cons of taking the annuity, the first which is inflation. We're all familiar with what inflation is, although it's been very low the last number of years. Inflation over time, and most people's retirement timeframes are 20, 30, even 40 years. That is a very long time for your monthly paycheck to not increase. Imagine working for Exxon for the last 30 years and never getting an increase in pay. Well, that's what happens when you take the annuity. The amount of money that you are guaranteed in month one is the same at the very end. The second negative or con of taking the annuity is you will have taxable income every single year, whether you need it or not. So you have less control over your taxes in retirement. And the third negative of taking the annuity is that there are no residual benefits to your heirs. Now you do get to name, you have the option to name a co-annuitant, likely your spouse, so that if you were to unfortunately take the annuity and die in year one, your co-annuitant can have the annuity for their lifetime. However, when the two of you pass, and God forbid that were to happen sooner than later, the money's gone. Nothing left for your children, for your heirs, or for charity. So, having said all that, our experience has shown over the last 10 plus years that almost every single one of our clients has taken the lump sum at retirement. Well, why is that? So we're going to explain a little bit in the next slide the relationship between interest rates and your lump sum. We all remember as children playing on the playground and playing on the seesaw. Well, as you recall being on the seesaw, when one side goes up, the other side went down, and vice versa. Well, that relationship is the same between interest rates and your lump sum. ExxonMobil and all companies that offer a pension or lump sum uses interest rates to calculate how much the lump sum would be at your retirement given current interest rates and based on your life expectancy and a very complicated formula that we're not going to get into, to determine how much, if you chose the lump sum, how much should that lump sum be? Now, as the seesaw shows, the lower the interest rates, the higher your lump sum amount. The higher the interest rates, the lower your lump sum amount. So where are interest rates? What has the bond market done over the last 40 years? Most of us maybe have kept up with the stock market. We know that over the last 40 years, stock market is up a lot. But what has happened to the bond market over the last 40 years? Well, let's take a peek. This next slide shows what the interest rate on a 30-year US Treasury bond has been since the early 80s. As you can see on the far left, if you were to have purchased a 30-year bond from the US government, they would have guaranteed you over 15% a year of interest every single year for the next 30 years. Can you imagine? From 1980 to 2010, if you held on to that 30-year bond, you would have received 15% a year of interest. Well, over the last 40 years, as the slide shows you, interest rates have gone from 15% to under 1.5%. Today, if you were to buy that very same 30-year US Treasury bond, your interest for the next 30 years would be under 1.5%. So think back to the seesaw analogy. In the early 80s, when interest rates were 15%, no brainer, you take the annuity. Fast forward to 2020, when interest rates are under 1.5%, and it is the best time ever to take the lump sum. Now, Exxon uses 3 different interest rates to calculate what the discount rate, as it's called, is for you when you decide, when you retire, to take your lump sum or annuity. And believe it or not, we track these 3 segment interest rates very closely. In fact, quarter by quarter, we update our chart that you can see here to see what the 3 interest rates, how they are yielding from quarter to quarter. And again, Exxon has a complicated formula that we're not going to get into now, but the point is they do use 3 different interest rates, which are shown on this slide, to calculate the discount rate for those of you, and this is very important, for those of you that were born after 1957. If you were born before 58, there's a different discount rate, but we believe most people on the call today are born after 57, and thus this calculation is what's used for you. If you were born before 58, we can talk one-on-one, and we can talk about that interest rate and what that looks like. But both of them, both methods today are at all-time lows. What you can see on the chart is that there has been a downward trend in these interest rates for many years, and it's really sharply gone down since the second quarter 2019. In fact, we are at all-time lows, as I just mentioned. And remember again from the seesaw analogy, low interest rates means a high lump sum. Now, we track this quarter by quarter, as I mentioned, and if any of you would like a copy of this slide as we continue to update this going forward, please send us an email and we'd be happy to send you a copy. Okay, I've talked enough and I'm going to hand it over to Doug to start talking about some of the common questions that we get from our clients about this lump sum versus annuity decision.
Thank you, Daniel. I'm going to look into 4 different questions that people often ask as they're contemplating lump sum versus the annuity. And I'm going to start by paraphrasing Jerry Maguire, where's the money? Well, if you take the ExxonMobil pension benefit as an annuity, also called a pension, ExxonMobil is responsible for sending you your monthly benefit. That's where the money is. It's either in an ExxonMobil pension trust, or potentially Exxon could hire an insurance company to send you your monthly benefit. If for some reason ExxonMobil were to renege on its promise, which we think is very unlikely, there is also a government agency, the Pension Benefit Guaranty Corporation, which insures pension benefits, but their coverage is fairly limited. But as I mentioned, we don't think it's realistic to fear that Exxon's going to renege on its promised pension benefit promise to you. If you take the lump sum, the corporation is fulfilling its obligation, meeting its commitment by sending you the money. So you're going to invest that money and hopefully generate a sufficient rate of return to be able to generate a stream of income which will sustain your standard of living and be roughly equivalent to what you would have gotten or more with the annuity. If you invest well, you can generate more money and actually increase the amount of assets that you have for daily living. And contrary-wise, if you invest in a single stock that goes belly up, well, you're probably not going to have enough money to sustain your standard of living. With that as background, let's move on to a second concern that people may have as they contemplate this decision.
And Doug, before we get on to that second concern, a couple questions have come in that I'd like to ask you.
Sure.
Because they're relevant to the couple previous slides. So the first question is, what options are available for someone that's 55 years of age, but does not have 15 years of service with ExxonMobil?
Well, if you terminate your employment without the 15 years of service, you have a vested pension benefit, but it's payable in full only as an annuity at the age of 65. If you were to receive it earlier than 65, it will be actuarially reduced because it'll be paid over a longer period of time. So my recommendation would be, if you can, continue to work at Exxon until you get that magic 15 years, what people call being bulletproof. Get the 15 years so you get retiree status, which comes with a lot of benefits, including currently retiree medical and a few other things. But if you do have to leave, or you're not given the choice to stay to achieve 15 years, there is a benefit available to you that you can get at 100% at age 65, or at a reduced amount if you take it prior to 55. prior to 65. You can take it actually as early as 50 if you terminate without retiree status.
So Doug, if you're say 57 years old and you have 12 years of service, are you able to request from the benefits department a pension estimate for what that lump sum or annuity would be, given that you're going to have it?
I think they will generate an estimate of what it would be payable at 65, and then you can look at the reduction for what's called early retirement actuarial reductions.
Okay. And a second question was, do we know yet how Q1 2021 discount rates are tracking so far?
Well, I've been following it, and it's a little early to say. We'll know better in another couple of weeks. Mid-October, they'll probably announce it. But right now, I would think first quarter may be comparable or perhaps even a little lower on the 3-segment yield curve than the fourth quarter of 2020. For those who are grandfathered under the previous regime, I think it's going to be comparable to the interest rate used for the fourth quarter of 2020.
Great, thank you. Okay, those were the 2 questions thus far. Good questions, please keep them coming, and we'll continue on. Thank you, Doug.
I might just interject, thinking about it, Daniel. The annual comp and benefits statement, which Exxon employees should get typically around April or May, should have a projection of what your annuity or your pension benefit would be at age 65. That would assume, however, you continue to work until 65. So I guess my recommendation for the 57-year-old with 12 years of service is probably to ask for a pension estimate from the Benefits Service Center. You can do that online. All right, second question, what protection is there from inflation? We covered this briefly in a previous slide, but as most of you know, inflation is really at historic lows, and most of us don't worry too much about the rising costs of goods and services. However, some of us gray-haired folks remember the high rates of inflation we had in the 70s and early 80s when mortgage rates were well into the double digits. Raises actually were in the high single to low double-digit rates, and inflation was roaring ahead. So even while inflation is fairly modest right now, as Daniel mentioned, most people looking at retirement are envisioning 20, 30, 40, 45 years of maintaining their standard of living. And you might want to consider, how are you going to protect your purchasing power? Average historic rates of inflation are typically in the range of 2 to 3% over a long period of time. But even at 3%, your purchasing power gets halved in 24 years. So that nice dinner out with a fine bottle of wine that might cost you and your spouse maybe $150 or $200 today could cost $300 or $400 by, say, 2044. You're going to need twice as much money if inflation's 3% over the next 24 years. You need twice as much money to buy the same things that you're buying today. Annuities are generally fixed. Cost of living adjustments are typically not included in the corporate benefit plans. Exxon offered cost of living adjustments to those retirees back in the 60s and the 70s as they were going through high inflation of the 70s and early 80s. But after the pension lump sum option was made available to all employees in mid-1980, mid-1986 or so, those cost of living adjustments have pretty much been stopped for all. So I wouldn't count on any adjustments coming down the pike, even if inflation comes back on ExxonMobil annuity payments. One of the advantages of a lump sum, of course, is that by investing in stocks and stock funds, you can actually outpace inflation and preserve or even enhance your purchasing power.
Good. So Doug, I'm going to interject again for a minute. One with a comment and one with another question. The comment, thank you, Jesse. Jesse wrote that an employee can go online to the benefits portal and run the pension benefit estimator and choose one of about 15 different options. So you can modify your years of retirement, you can select your estimated raises, etc. There's lots of options now in the benefits portal to do that.
One of the disadvantages of being a retiree is I don't have access to that portal. That would be a nice thing to have.
The second thing, Doug, is another question. And this question is, do you think it's possible that Exxon could change the pension to only having the annuity as the option? In other words, could they eliminate the lump sum option altogether?
Well, I'm not a benefits lawyer, so I'm giving you my best understanding, but I'll hedge it a little bit by saying tax and benefit lawyers have the final say on that. My belief is they need to preserve your accrued benefits, the benefits that you've acquired to the date of any possible future change. And among those accrued benefits, I believe, would be the distribution right. That is to say, the opportunity to get a lump sum distribution of your pension benefit. Prospectively going forward for benefits earned after a certain date when they may change the plan, they do not necessarily, I believe, have to offer the lump sum. But that's up, the corporation is free to do pretty much what it wants to do with respect to these voluntary benefits that it offers, and eliminating the lump sum option, I suppose, is a possibility, but I don't believe they can do it retroactively for benefits which you've already earned or have been vested. That's my best understanding.
Good, great, thank you.
All right, shall we move on to the next slide? Some people will wonder, and Daniel addressed this a bit, when I die, what's available for my spouse or my children or other heirs? Well, the answer here is fairly simple for the lump sum. What's there is what's there. What's left is what's left. As they say, you're not able to take it with you, although some may try. Let me interject here. Have you heard about this elderly gentleman named George, who on his deathbed called together his accountant, his best friend, and his lawyer? And he said, well, I've heard I can't take it with me, but I'd really like to test that for sure here on my deathbed. So he gave each of his three associates $1,000 and said, I want you to promise me that at my funeral, you'll put this money in an envelope and insert it in my casket so I can see if I can actually take it with me. Well, George passed away, had the service, and afterwards the three colleagues there were getting together, sort of doing a debrief of the funeral and the service. And the best friend says to the others, he said, you know, I really didn't understand why George wanted me to try to put some money in his coffin. So I was skeptical. I only put $500 in the coffin. Then the accountant said, well, you know, I didn't really know whether George was talking pre-tax or after-tax, so I only put $700 in the envelope that I put in his coffin. At that point, the attorney, the lawyer, turns to the other two and says, well, I'm just really ashamed of you guys. You took George's money and you didn't put it all in the coffin? Why, I wrote him a check for $1,000 and put that in his coffin. He got it all. Well, unless you're like George, if you take the lump sum, what's left when you pass away is what's left when you pass away. If you are taking the annuity, you got several options. You can name, as Daniel mentioned, you can name a joint annuitant, which is typically a spouse. And then if you die before your joint annuitant or your spouse, the spouse can potentially get a portion of the annuity that you were getting. It's typically either 100% or 75% or 50% or 25%. There's also an option that you can choose what's called a period certain. It's a guaranteed number of payments. And those options typically are 10 years, 15 years, or 20 years of monthly pension payments guaranteed, whether you live or not. Now, with both of those, there will be some reduction. In the case of a joint annuitant, the company is going to be paying a benefit over 2 lives rather than just one. And in the period certain, they are ensuring that those payments will be made for the length of time, which might not happen if you didn't have those guarantees. So both of those payments are going to likely be reduced to some extent. If you choose to have a joint annuitant or a period certain, you can get those estimates when you finally get close to retirement in the intent to retire package. They'll enumerate all the different options about lump sums, partial lump sums, and all the different annuity options. Or you can go online, as Jesse said, or actually through the Benefits Service Center and get an estimate of a pension estimate, which would dictate or indicate what those options are. Having said that, let's move on to what I think is my fourth question here. How irrevocable is my decision? Well, in the minds of ExxonMobil, it's pretty much a one-time decision. You choose the annuity or the lump sum or the combination of both at the time that you retire, filling your intent to retire package and submitting it to the Benefits Service Center. And that's pretty much it. From their perspective, from Exxon's perspective, you've made a decision, you've made your choice, and you'll live with it. If you've opted for an annuity, there's really not much else that you can do. You're going to get that monthly paycheck for as long as you live. And it's under the terms and conditions you agreed to when you retired. If you opt for a lump sum or a partial lump sum, you can consider purchasing an annuity at a later date from an insurance company. There is an active annuity market available. And if down the road you should choose, I would like to get a fixed amount every month, you can purchase an annuity in the commercial markets. That's an option you have almost at any time. So Daniel, these are, I think, the important questions which folks will need to consider. But do you have any additional advice on things that people might want to think about as they make their decision on lump sum, annuity, or a combination of both?
Yeah, sure.
Over to you.
Thanks, Doug. I do. There's a couple additional thoughts that we think you should consider before you make this big, irreversible decision. Think through the pros and cons that we've outlined in good detail this afternoon. And then there's a whole host of other things. So for instance, what other income sources do you have? One thing for sure that you'll have is Social Security. We don't believe that your Social Security benefits, and I'm talking to those that are close to retirement, that your benefits are going to be greatly reduced. Maybe mine will, because maybe 20 years from now when I go on to Social Security, there may not be as much there, but certainly those retiring soon, we think you'll get your benefit. They may make some changes. Maybe they'll tax all of it, not 85% of it. Maybe the inflation of it won't be as much going forward. But think about your other income sources. The second thing is to think through your tolerance for volatility. Investing the money in a lump sum means that the money will be invested in both stocks and bonds. And as we mentioned tonight, will go up and down with the value of the markets. We think a way to kind of hedge against those downturns and to mitigate that volatility is to set aside 1 to 2 years of your cash flow needs in either cash money market or really short-term bond funds that are there and safe and stable, so that when the market does take a turn down, those assets are protected and you can sleep at night knowing that you have set aside a year to two of your cash flow needs. The second thing is, what are your genes like, right? You have good genes, then maybe the annuity makes more sense because you may live a long time. If you don't have as great genes, then the lump sum may make more sense. What are your personal goals and objectives with the money? Are you okay with the money going away if you were to take the pension and if you were to die early? Or do you want to ensure that you can leave a legacy to your family or to charity? Who's going to manage the money? We've talked about that already. And as we've mentioned, you do have the option of taking a partial lump sum and partial annuity. That's a newer option that's available, and that's something that you should consider. At the end of the day, we think having a financial plan that can put all of these moving pieces together for you is a very important step, and we talked about that a lot last week. Okay, I think we've beat this horse to death, as it were, in terms of the pension versus the lump sum. We're going to switch gears now and talk about the ExxonMobil savings plan. And I'm going to transition over to Doug. I don't see any new questions. So Doug, I think you can start with your explanation of the savings plan.
All right, Daniel, you've beat this horse to death. Is it no longer a lump sum? Now it's a limp sum? I don't know. Let's turn to choices with the EMSP. At retirement, first thing to know is you don't have to take distribution of your savings plan. You can maintain the savings plan in the savings plan until, I believe, 72. And at age 72, either with an IRA or with a tax qualified savings plan like the EMSP, you'll need to begin taking what's called required minimum distributions. Now, most people do take distribution of their savings plan after they retire because they want to have maybe more control over their assets. They want to have broader array of diversification, investment and diversification options than what's in the plan. And they also want to be able to take the money when they want it, as opposed to only once or twice a year. Within the plan, as a participant, you've also got a lot of choices. First thing I guess to know is that you can invest before tax, after tax, in a Roth 401k, or you'll have an account in the general account, the company's contribution when the company's making matching contributions. Most of what's in your plan is going to be comprised of what we call before tax or pre-tax or non-taxed money. What I'm talking about there would be things like contributions to the before tax account, earnings on your after-tax contributions, and the company's contributions. Those assets are all going to be distributed among the various accounts that you have. Now, there's also some after-tax money. If you make contribution to the after-tax account, that money comes in on an after-tax basis rather than a before-tax basis, and that's shown or will be shown in green as a portion of the after-tax account. Now, at distribution, let me say a couple of things. First, at distribution, you can only take out of the savings plan cash and or stock, ExxonMobil stock. All your investments in the equity units, the international units, the extended market units, and so forth, all those investments will be liquidated and turned into cash at the time that your account is distributed. So you'll take cash and or stock out of the account at distribution. The before tax or pre-tax or non-taxed money in the before tax account, the general account, and that portion of the after-tax account, which is earnings, that can be distributed into an IRA. That's typically what people do when they take distribution. That money has not been taxed. You haven't paid taxes on it, and you can move it into an IRA in a tax-free transaction. Once in the IRA, you can take it out and then pay taxes on it, but moving it from the savings plan to the IRA is not a taxable transaction. I think the slide can show the three options that people have at retirement, either an IRA, a Roth IRA, or a brokerage or a savings account. So at distribution, that before tax money will flow into an IRA typically. So it comes out of the general account, the after-tax earnings, and the before-tax account. All right. If you have a Roth account, Roth 401k or conversion or a rollover account, the money coming out of a Roth account can flow into a Roth IRA in a tax-free transaction as well. It's similar to what was done with the before-tax money going in an IRA. It's just from the Roth to the Roth IRA. Now, there are rules on taking money out of a Roth IRA without any penalties or paying any tax. And we won't go into the specifics here, but generally speaking, excuse me, you'll want to wait until you're 59 and a half and the Roth IRA has been established for at least 5 years before you begin taking money out of the Roth IRA. What about the after-tax money? The green here in the after-tax account. Well, that money can be used for a variety of things. Typically, it can go into a brokerage account. You could get it as basically a tax-free check. You've paid taxes on it. Or you can use it for reducing taxes if you should choose to take stock out of your account as stock, which we'll get into in a little while. You can also roll any excess after-tax after-tax money into a Roth IRA. All right. Just for completeness sake, I will mention that after-tax money could theoretically also be rolled over into an IRA. We would strongly recommend against it because you'll be setting yourself up for a lot of record keeping to try to distinguish between tax paid and non-tax paid money. And it's not worth it in our opinion. Okay, I hope I've covered that sufficiently so you understand the typical options that you have when you take distribution of your ExxonMobil savings plan. However, we haven't yet talked about taking stock out as stock. Now, what about ExxonMobil stock?
Thank you, Doug. And before we talk about your options with the ExxonMobil stock, we have a question that came in, which is, can you take the after-tax portion of the account in cash to cover debt or pay for university without tax consequences, understanding that it means you don't take advantage of the Roth IRA option?
The answer to that is yes. I did indicate that you could have that after-tax money sent to you as a check or distributed to your brokerage account. You've paid taxes on it. At retirement, if you're taking a full distribution of your account, you can have after-tax money segregated from before-tax money and used either for a Roth IRA contribution or, as we'll get into, to reduce your taxes on stock, or, as a question asked, to pay for debt or college expenses.
Great, thank you, Doug. And I'll give you a few minutes to catch your breath and get a sip of water.
Thank you.
A lot of information on all the options with your ExxonMobil savings plan. We're now going to talk about your options of your ExxonMobil stock within your savings plan. As we see it, you have three options of what to do with your Exxon stock. The first option is when you take distribution, when you roll over your savings plan to an IRA, the Exxon stock within your savings plan can be sold just as the other investments would be sold and transferred as cash to your IRA. The second option is if you wanted to hold on to the Exxon stock, you can transfer it in kind to your traditional or Roth IRA. Now, you can't transfer the equity units or the international units or the bond units in kind, but you can transfer your ExxonMobil stock in kind. And the third option, and this is the one we're going to spend a few slides on, is you can take advantage of the NUA strategy to take the Exxon stock out of your savings plan and into a brokerage account with some big tax advantages. So on your ExxonMobil statement, you've probably been seeing the statement over all the years, quarter by quarter. You'll notice near the back is a listing of all of the ExxonMobil stock that you own in the account. And you'll see that it's broken down into different cost basis buckets. So if we can turn to the next slide, this is a snapshot of a ExxonMobil savings plan Voya statement. And what you can see here along the top are four different buckets: the before tax, after tax, general, and the stock match account. On the left-hand side, it says cost basis. Those amounts, starting at 14 and going down to 40, are the amounts that this participant paid for their ExxonMobil stock over the years. So if we can just hone in on one example, you'll see that in the before tax account, the column near the left, there are 20 shares with a cost basis per share of $26, which is a total cost of $533. So this participant, when Exxon was trading at $26, bought 20 shares, and it cost them $533. So these lots of stock are very important. When we analyze your ExxonMobil savings plan, we look very closely, if you have Exxon stock, to see what your cost basis is. And even with the price at $33, stock bought at $14, right, still has a nice spread to 33. If we turn to the next slide, what we're illustrating here is if you were to take the stock out of the savings plan. And so we kind of have a brief example here. Here, the cost of the stock is $25 a share. If the fair market value were 40, and we're hoping it gets back there sooner than later, then your difference between 40 and 25 is $15, and that is your NUA, your net unrealized appreciation in the stock. If you were to take that stock out, the cost basis of those shares, which in this example is 2,500, that is not offset by what's called your tax paid credit balance. And we're going to show you where you find that number on your statement. Any amount of cost basis that's not offset by that tax paid balance is treated as taxable income. And we're going to go through an example to show you how this works. Any stock that you do take out and then sell, the gain, the NUA, the $15, is taxed at capital gains tax rate and long-term capital gains tax rate, which, as most of you know, is much more favorable than your ordinary income rate. So we're going to now show you where you can find what your tax paid balance is on your statement. It's typically on page 3, and it's in a section there that says pre-87, post-1986 contributions. And what you can see there, and some of you will have balances in both, depending on how long you've been there, but those numbers together is what's called your tax paid balance. It's the amount that you've put into the savings plan on an after-tax basis. And it's that dollar amount, in this case, almost $44,000, that you can use to offset the cost basis of all the Exxon stock you want to take out. So we're going to go through an example now that we've kind of talked about the terminology and where to find it on your statement. We're now going to go through a more detailed strategy and show you 2 options. So here are the assumptions. Sally has 1,000 shares of Exxon in her savings plan, and those 1,000 shares have a total cost basis of just over $28,000. The 1,000 shares are broken down into 2 lots. The first one is 400 shares that she paid $33 a share, and 600 shares where she paid $25 per share. Now her tax paid balance, the number that we just showed you on the previous slide that was $44,000, Sally's tax paid balance is $12,000. And the current value in this example of Exxon is $40. So what are some of Sally's options? Well, here are 2 of them. The first one is she takes out as much Exxon stock as she can, using up all of her tax paid balance. And the calculation for that would be she would be able to take 480 shares of her $25 cost basis stock. So how do we get there? Well, we multiply 480, number of shares, times 25, cost per price, and that equals $12,000. $12,000 is what she has in her after-tax contributions, otherwise known as her tax paid balance. So her taxable income to take out the 480 shares is 0. At $40 a share, the current value of those 480 shares is just over $19,000. Now, there is some tax to pay. It's not a completely tax-free transaction. And as I mentioned earlier, the tax that does get paid in this example is if those 480 shares were sold the day after she takes them out at $40 per share, and she got $19,000, she would have to pay long-term capital gains rate. In this example, we're using 15% on the difference between the fair market value, the 19,000, and the cost basis of 12,000. So she'd pay 15% on $7,200, which is $1,000 in taxes. So the net amount that Sally would have in her hand to spend is $18,000. And it cost her $1,000 to do it. Think about it, had she taken that $19,000 out of her IRA as a distribution. If she did not do the NUA strategy, she would have to pay ordinary income taxes on the full $19,000. Now we'll talk about the second example, another option she has. What if she wanted to take the full 1,000 shares of stock? Well, as you can see here, the cost basis on those 1,000 shares is just over $28,000. Her after-tax contribution is $12,000. So at the time of distribution, she would pay ordinary income taxes on $16,200. That's the difference between the cost basis, $28,000, and her after-tax contributions. So she'd pay ordinary income on $16,000. She would now have $40,000 worth of stock in her name outside of the IRA. If she were to sell the stock, if she were to sell the stock, she would pay two taxes. The one I mentioned, right? Ordinary income on the $16,000. And in this example, we're assuming she's in a 22% tax bracket. If she were, she'd pay just over $3,500 in taxes on that $16,000 of income. And number two, she'd pay long-term capital gains tax rate, we're assuming 15% here, on the difference between the fair market value of $40,000 and the cost basis of $28,200. So she'd pay an additional $1,700 in taxes. So she takes out $40,000, she pays just over $5,000 in taxes, and she has $35,000 in cash. Again, contrast that to her not doing this strategy and just withdrawing $40,000 from her IRA. In that case, she would have to pay ordinary income taxes on $40,000, and she would net much less. So lots of numbers. Hopefully that was understandable. I don't see any questions come in, so that's a good sign. And now I will talk about some of the advantages. So why might you choose to exercise the strategy of NUA? Well, I've talked about the tax advantage, right? There's a big tax advantage of doing this. You can pay capital gains tax rate instead of ordinary income tax rate. And this year, in 2020, there's a big difference between those two rates. Capital gains tax rate are at 15 or 20%. Ordinary income go up to 37%. The second reason is for those that are retiring between 55 and 59 and a half, you may need a bridge of money in those years in order to fund your living expenses. Exercising this NUA allows you to take stock out, do it in a tax advantage manner, and you now have cash with which to live on before you get to 59 and a half. Why do we mention 59 and a half? Well, that's an IRS law that says if you withdraw from your IRA before 59 and a half, not only do you have to pay taxes on the money, but you also have to pay a 10% penalty. The good news is if you kept the money in your savings plan from 55 to 59 and a half, you are able to take money out of the savings plan, pay taxes, but not have the penalty. Now, you can only do this once or twice a year. You can't do it every month, but there are ways, and we can talk about this if you like in detail, of how you can get money between 55 and 59 and a half should you need it. Another advantage of doing NUA. For those that are charitably inclined, having low basis stock in a brokerage account is a great asset to gift to charities over time. Why? Well, you get to take a deduction, a charitable deduction, on the fair market value of your donated stock, and you don't have to sell the stock and pay the capital gains taxes. So we have a number of clients that have very low basis stock at $12, $15 per share that donate it to their charity or their donor fund and get to take a full deduction on the fair market value of Exxon. Now, we know that the advantages today with Exxon trading at just $33 are not nearly as good as they were, gosh, just a year ago when it was at 60 or 70, or not too many years ago when it was in the 80s or 90s. But there are still some advantages, and if you have low basis stock that's in the $10, $12, $15, $20 per share, we still think that there's a tax advantage to exercising this strategy. Okay, I've talked for enough. I'd like to now turn it back over to Doug, who is going to talk about the mechanics of taking your distribution from your savings plan.
Well, while you can submit paperwork to get your pension payment to you or into your IRA, you've got to be more actively involved to take distribution of your savings plan account. It involves a telephone call to Voya, the administrator or the custodian of the savings plan. First thing I'd say is you have to wait at least a couple of days after you've retired so that their HR systems reflect the fact that you are no longer on the payroll. You have to be retired to take this complete distribution. I would suggest that you have information available for the call to cover both the accounts into which you want that money deposited, the IRA or the Roth IRA, and you need to know what you want to have done with your assets. You know, do you want to exercise any NUA stock? If so, which shares and how much? How much of your after-tax contributions do you want to allocate or apply towards the cost basis of that NUA stock? The liquidation of your investments, your extended market, your equity units and all that, that's all going to happen on the following business day. So you can't really time the day to do the transaction. You're doing it typically a day ahead of when all those assets will be liquidated and turned into cash for you. If you choose to take stock as stock, either to exercise NUA or to move it into an IRA, you'll probably want to establish online access with ComputerShare, which is the stock transfer agent for ExxonMobil, both to know when the shares have arrived in your account and also to be able to download statements that you may need to use in transferring those shares into your brokerage account for NUA or into your IRA. I would say it's a fairly lengthy process. You'll talk to typically one Voya representative at the start who will take down basic information. And then that representative will typically pass you over to a second representative who will confirm the information and finalize the transfer. It's not easy, it's lengthy, it's a little painful, probably take 45 to maybe 60 minutes to do. And finally, I would say you will get a distribution statement from the savings plan, which will have a wealth of information, especially if you take out NUA stock, that you'll need to retain for tax purposes as you begin to do your taxes in retirement. So hold on to that statement. It's called a distribution statement. You want to make sure you have copies of that when you prepare your own taxes or for your tax accountant. With that, I think I'll turn it over back to Daniel.
Excellent. Thank you, Doug. And we are just at the 1 hour mark. So we appreciate you hanging in there and sticking with us. We are done. We are going to kind of summarize and talk about next steps. But thank you very much for hanging in there. So kind of in summary of tonight, what we've talked about, we talked about the pros and the cons of the choices that you have with your pension and your savings plan. We talked in good detail about NUA, the net unrealized appreciation. For those that weren't as familiar with it, hopefully now you have a better understanding. And then Doug just mentioned the mechanics of how you actually take distribution from your savings plan. So we know we went into a lot of detail, but we know this stuff, as I'm sure you can tell. Doug, having worked at Exxon for over 30 years, clearly was in the know of all the benefit programs. And we have helped clients, ExxonMobil clients, retire from Exxon for over 25 years. So we've done this a number of times, and we can help you throughout the whole process and really hold your hand in doing so. Next steps, kind of before we get to the Q&A, and as we've answered questions through the webinar, at this point we only have one still to answer. But briefly, our third part of our three-part series is going to be next Thursday, October 8th, same time, 5 o'clock Central. If you've already registered for the series, so you don't have to do anything on your end, you'll get some confirmation reminder emails with the links. Next week, we're going to talk about how to fund life after ExxonMobil. So a very important step in the process, and we hope that you can listen to us live next week. If not, we will be sending out recordings to all of you regardless. As soon as today's webinar ends, a quick survey will pop up. There's only 3 questions, and we ask if you could please take a minute to give a little bit of feedback. We'd really, really appreciate it. It means everything to us to hear from you, your thoughts on today's webinar. Tomorrow, you're going to get an email with 3 different items. One will be a link to the recording, as well as the slides. The third thing is a link if you were interested in setting up a one-on-two video call with Doug and myself. There'll be a link there for you to click on to schedule a call where we can speak with you individually about your personal situation. This call is free, won't cost you anything. There are no obligations, but we can help answer your specific questions that you may not have asked this evening. In addition, on our website, which is at www.investecwealth, the same calendar links are there right there on the homepage. So as you can see here with the red arrows, if you click on Let's Talk, that will sync directly into Doug and my calendar, and you'll be able to select a time that suits your calendar. While you're on our website, if you are there, we'd direct you to the blogs page. Doug has written a number of blogs specifically on ExxonMobil benefits, and the latest one, which we just published this week, was what to do now that Exxon has suspended the match. We get that question from a number of our current Exxon clients that are still working at Exxon, and there's a lot of great information there for all of you. If you do decide to schedule a call with us, not only can we discuss your ExxonMobil benefits, but at Investec, we offer a lot of different services. We don't want you to be overwhelmed by this slide, but we put it here just to show you, to illustrate the breadth of services and the number of areas and topics that we can cover with you at the appropriate time. Not all of these boxes will be relevant to your situation, but we have a team, as I mentioned, of 6 advisors that can work with you to help you in all aspects of your personal financial life. Okay, we'll turn now to the Q&A. Doug, I see one question.
I'll try to handle it, Daniel. The question is there a benefit to selling the stock with a cost basis greater than the fair market value, or does NUA only have a benefit for lower cost basis? I'm tempted to say if the questioner would contact us, we could talk about his or her personal circumstances and understand exactly what they're wondering about. In general, I think what the question is if you were to move stock with a cost basis higher than current market value into a brokerage account, is that a worthwhile exercise? Should you then go ahead and sell that stock? The answer to that's a little complicated. First, the question would be, well, how much after-tax contributions do you have? What's your after-tax credit balance? Are you going to have to pay taxes to move that stock into the brokerage account? Even if you don't have sufficient after-tax contributions to cover the entire cost, it may still be worthwhile because you're generating funds that you may need by selling that stock. You may have to pay taxes, and give you a sort of a simple example. If the current market value of Exxon is 33 and you have no after-tax, you move a share at $40 over, your cost is actually the lower of market value or cost. So you'd be charged, I think, $33 for that $44 share or whatever. Then you can sell that having paid taxes on it, and the net proceeds will be more than the taxes. So you'll generate funds. But without getting much more complicated, I'd suggest the individual either send us an email or book a phone call, and we'd be happy to talk in more detail about their individual circumstances.
Very good, Doug. So no more questions have come in. So I'll close with just a brief kind of story. If we can turn just to the final slide. We've talked a lot about the options that you have, and hopefully doesn't sound overwhelming. We know that we've done this before, and we can help you get through this process. And we've seen it time after time with our clients. And there's one client in particular that I can recall so clearly, who would come into our office while he was working with his suit and tie on, with his BlackBerry tied to his hand the entire time, before our meeting, during our meeting, after our meeting. He was tethered to his BlackBerry. And he retired, and we helped him through this process. And he came into our office after he had retired. The BlackBerry was gone. The tie was gone. He was wearing shorts and a t-shirt and a golf shirt, and he looked so relaxed. He couldn't be happier. And we have seen this time and time again with our clients. Once you've made the decision to retire, we have yet to hear from any of our clients that have regretted it. You too, once you've made that decision, will not look back. And it's not as stressful and difficult as it may seem. We are here to help you get through the process, try to simplify it as much as possible. And we appreciate the time that you've taken with us tonight. We hope that you can join us next week. And we'd like to thank you again for being here.
Thank you very much.
Have a great night, and we look forward to seeing you next week.